All right, folks, one of the thinking out there is that one of the things that's held back the broad stock market, not talking about those handful of names Jim and I were talking about, it's just the competition from yields, right? Money markets are yielding, bonds are yielding. Here's what a lot of folks are saying. This is when we get to 4.5, below there, when you get below that number, because what you've seen is as yields went up, stocks went down, or at least the flows into stocks, that this will turn everything around. And my next guest happens to agree. I'm going to bring in Trader A co-founder Aisha Tariq. Aisha, so just this notion that this competition from these yields is enough to sort of keep people dumping stocks, going into money markets, going into bonds. Is this as simple as turning this flip, or flipping the switch?
Hi, Charles. It's a pleasure to be back. Well, yes, we think so. We think that if yields can stay below 4.5%, we would be in the clear. And the reason we think yields can actually stay below 4.5% is because the economy is weakening a little bit. So I'm not going to say it's weak, but of course we're seeing a slowdown in growth. And when we see that, the long end of the curve usually stays depressed. So, and that's, in one way, that's actually good for stocks.
I got some other things, points that you say for a more sustainable market. Okay, so we've hit the yields below 4.5%. Weaker dollar, which is interesting. I've talked about this on the show, particularly during earnings season. Ironically, companies that do more business overseas saw lower revenues, but much higher earnings as they convert to dollars. But I want to ask you on two other things that stand out. Inflation. We need to see inflation to a degree for a stronger stock market, for more sustainable market rally and inflows.
Yes, that's right. So if you remember what happened in the last 2 years, we did see inflation sort of, pull up revenues, right? And so a healthy level of inflation. So if we have excess inflation, obviously that's not good for anyone. But then a healthy level of inflation at around 3% or so could actually be a little bit of a tailwind to stocks over here. And that's actually one of the reasons that some of the banks are increasing their price target for the S&P.
All right, I've got to talk about some trading ideas that you've got that you're going to share with us. You've got LQD, which is investment grade bonds, Palo Alto Networks, and also Xylem. Let's start with the investment grade bonds. How large of a position would this be in someone's portfolio?
So I would start to scale in over here. So it goes back to a series of, flows that we saw coming out of Bank of America's report, similar to what you showed earlier in the show, where we saw a huge number of buying in investment grade bonds, the highest since September 2020, in fact. And I think there is something to that. So with the Fed cuts coming, sometime this year, we might see the shorter end come down. And of course, as I talked about, the longer end also coming down with the deceleration of the economy, we think that there is an opportunity here for, capital appreciation.
Okay, and of course, the Palo Alto Network is intriguing because that big miss they had and the stock got hammered. And water is a good play, but I got 30 seconds. Your dividend ideas here, I generally like them. You got an oil play, you got a telecom play, and then Newmont, a gold play here. This has been a horrific underperformer in general, the dividends. Should people start to really scale in heavy here?
So I don't think scaling in heavy would be the right idea, because we're still in a place where earnings haven't taken off as they should. So I think, scaling in bit by bit, so I'd say 25% at a time would be a good idea.
All right. Aisha, always great talking to you. Thank you very much.